For many individuals, owning a home is a major objective or life dream. It provides a sense of comfort and a sense of self-worth. A mortgage is a loan used specifically to finance the purchase of your home, which is typically paid back usually within or up to 40 years. Mortgages are distinct from personal loans and student funding programs in that if you don't pay back the lender, they can foreclose on your property. Here is John and Mary looking to buy their first home. They surf online to have a look for expert independent mortgage advisors on www.whatismortgage.co.uk and set up an appointment to see Alex, who is an independent mortgage advisor they found. After connecting with Alex, he listens to John and Mary's story and advises them on the two types of mortgages available. The first one being a typical repayment mortgage where John and Mary pay back the interest and principal each month until the loan is paid off. And the second being an interest-only mortgage where, for a lower monthly payment, John and Mary pay just the interest of the loan, but do not make progress in paying down the original loan amount over time. John and Mary opt for the repayment mortgage because at the end of their mortgage, they intend on having their home paid in full without the need to worry about making any more payments towards it. It saves them thousands of pounds in interest as it puts a cap on the amount of interest they pay over time versus an interest-only mortgage. As part of the mortgage process, Alex asks John and Mary about how much they are looking to put as a deposit on the mortgage, and also he asks to verify their identification, pull their credit report, income statements, and any other financial commitments they may have. This is to ensure that using his experience, Alex pairs the couple up with the most appropriate lender that suits them best. When discussing the different types of mortgage products available, Alex advises John and Mary about fixed-rate mortgages, discounted, tracker, and variable rate mortgages, and how they operate so the couple can decide which type of product they will opt for. As a result, John and Mary opt for a fixed-rate mortgage because they are looking for stability in their financial situation and do not want fluctuations in their interest rate. John and Mary reveal that they only have £14,000, but the dream home comes with a cost of £200,000. After doing an analysis based on the couple's financial situation, Alex determines that it is possible for John and Mary to secure a mortgage, issuing them a decision in principle for £200,000, and they would need to make a 5% deposit, while having some money available left over to cover closing costs of the mortgage. Closing costs would involve things like a fee for the mortgage advisor's service in setting up and organizing the mortgage, the solicitor to ensure all the required legal documents done properly, and any sort of transfer taxes that need to be covered. This ensures the mortgage is fully compliant and no potential issues will arise in the future as a result of this mortgage loan. Now, John and Mary are ready to go hunting for their dream home. After an extensive search, the couple finally finds their dream property and their offer is accepted. At this point, John and Mary rely on Alex to help them formalize their mortgage application, have an appraisal performed on the home, and a legal search is processed to see if there's any liens on the home they want to buy. Great news! After the application to the lender was sent, it came back as approved and the lender issued their mortgage. At this point, it's only a question of time until John and Mary move into their new home. John and Mary's mortgage was set up for a period of 35 years with a fixed term. That basically means that for 2 years, the interest rate on their mortgage will remain the same and not fluctuate unlike a variable rate mortgage. This is exactly what the couple wanted, as Alex had explained earlier, that a fixed-rate mortgage allows their monthly payments to remain the same regardless of interest rate fluctuations. At the end of the 2-year term, John and Mary can renew the mortgage for another fixed-rate period from the same lender, or they may opt to remortgage with a different lender who can offer a more favorable fixed rate. The biggest advantage of getting a mortgage is the fact that, rather than burning up their hard-earned money by handing it to a landlord in the form of rent payments, John and Mary can finally now establish equity, which is a type of built-in savings over time as they reduce their mortgage debt through their monthly payments. The longer they make their payments, the less interest they will have to pay as the balance of their mortgage decreases. As new homeowners, John and Mary also benefit from the value of their home increasing over time, which also raises their equity, adding more value to their home. Imagine 2 years later, the value of John and Mary's home has risen to £250,000 and John and Mary decide to sell their home. If they were to sell their home, John and Mary would need to pay back the balance of their original mortgage. In this case, presuming they build up £20,000 in equity, they only owe to the bank £170,000, as they had been making their regular monthly payments. This means they have made a profit of £80,000 to which John and Mary can now use to put towards another new home, or purchase a less expensive home within their new budget, which would allow them to be mortgage-free. A well-put-together plan is no accident. Alex, as their independent mortgage advisor, has put together a plan for success, which allowed John and Mary to go forward. Find the best information on mortgages and how you can get your dream home by going to www.whatismortgage.co.uk right now to find your independent mortgage advisor.